Walter Wofford back. Here we are, another episode for the short-term rental cash flow roadmap. And today we have an overview and getting our thoughts together on what's the best type of entity to buy with. Is it going to be a taxable or non-taxable? Then we got to figure out the funding sources. Is it going to be seller financing, or is it going to be a joint venture, or is it going to be a private lender or something else? And then if you're going to do an arbitrage where you don't actually own the property, you lease it with the right to sublease it, are you going to use a standard fixed rate lease, or are you going to use a performance lease? And where does your retirement account fit into all that? So this is a very important and interesting topic for you, and it'll help you get your thoughts together. All right, so as always, I've got my AI team, Bill and Judy, helping me to pull together the content and for the content delivery. Now, if you'd like to see our properties, just pull your camera out on this QR code, center it, and then follow the directions, and you'll be able to see our properties. And that is an hospitable, that's our channel manager that we use for all our properties. And I would suggest you do too. But it'll show you what their website looks like that's included in the monthly fee. Okay, big choices today. Walter Wofford out.
All right, welcome back, everyone. Today we're really diving deep into the world of short-term rentals, STRs.
That's right. Specifically, the different business models you can use.
Exactly. We're pulling our insights today from some great excerpts by Walter Wofford titled STR Business Models, Pros and Cons. And our mission really is to cut through all of the jargon. We want to break down each model, look at the pros, the cons.
Yeah, figure out what actually fits your goals. Are you looking for, say, long-term wealth?
Right.
Or maybe quick cash flow?
Or something else entirely, right?
Yeah.
So get ready for, hopefully, some clarity, maybe some surprising facts, too, that'll help you feel, truly well-informed on this stuff.
Definitely.
Okay, so let's unpack this first one, the ownership model. I think this is probably what most people picture when they think STRs or real estate investing.
Yeah.
You buy the place yourself.
Yeah, that's the classic approach.
But what does that actually involve day to day?
Yeah.
And what's the real appeal behind it?
Well, it's pretty straightforward in concept. You purchase the property,
Yeah.
could be in your own name, maybe an LLC, or even a land trust.
Great.
Then you furnish it, get it looking nice, and operate it as an STR. Listed on an Airbnb, VRBO, those platforms.
Right. Now, when people think ownership, they probably think, wow, lots of money up front. But the real interesting part, the deeper insight maybe, is how it sets you up for long-term wealth building in a way the other models don't quite match. Can you talk about that?
Yeah, absolutely. That's the key difference. See, unlike just leasing or managing, when you own it, the property itself is an asset that can grow in value.
Ah, okay.
You're building equity over time.
Yeah.
It's not just about the rent checks coming in, it's this appreciating investment. So you get both cash flow, the monthly income, and appreciation, the potential future resale value.
That combination seems powerful.
It is. And then there are the significant tax benefits, huge. You can deduct depreciation, mortgage interest, and there's something called cost segregation.
Cost segregation, what's that exactly?
It's basically an engineering-based study that lets you reclassify parts of the property, like carpeting, fixtures, to depreciate them much faster.
Oh, wow.
Yeah, it can seriously reduce your taxable income. Plus, you have more control, total control, really. Renovations, pricing, who you rent to, your rules. It's all you.
Makes sense.
And one more thing, refinance power. If the STR does well and builds equity, you can often refinance, pull cash out, and potentially use that to buy another property.
Okay, that's a compelling list of pros, but there's always a flip side, isn't there?
Yeah.
What are the big hurdles here, beyond just needing the money?
Well, the biggest one is the high upfront capital needed. No getting around that. Down payment, closing costs, furnishing, it adds up fast. And while having control is good, it also means all the risk is on you. If bookings dry up or new regulations come in, well, you still have to pay that mortgage.
That's a scary thought.
It can be. And finally, it's generally slower to scale. Buying properties takes time and capital, unless, you get creative with seller financing, find partners, or maybe use IRA funds.
Right. Okay. So summing that up, who's the ideal fit for this ownership model?
It's really best for investors focused on building long-term wealth, people who want that appreciation, want the tax strategies, and really value having full control over their investment.
Okay, that makes sense. But what if that feels like too big a jump? Or maybe you're more interested in faster cash flow right now without that huge capital investment. That brings us to rental arbitrage.
Yes, rental arbitrage. It's gotten a lot of buzz.
So what's the core idea there? How does it work?
Basically, you sign a long-term lease on a property, usually, 12 months or more, directly with the landlord.
Okay, so you're the tenant.
Exactly. Then, with the landlord's explicit permission, you furnish the place and rent it out short-term on platforms like Airbnb. You're arbitraging the difference between your long-term rent and the short-term income.
What's really striking there is how much lower that barrier to entry seems compared to buying. Like you said, it feels much faster to get started.
It definitely is. The low capital needed is a huge pro. No down payment. You're basically looking at first month's rent, security deposit, and the cost of furniture.
Much more manageable for many people.
For sure. And that makes it quick to scale. You could potentially lease several units relatively quickly, especially if you build good relationships with landlords who are open to this.
Right.
Also, critically, there's no debt or credit needed for the property itself. You're not taking out a mortgage. And it offers a flexible exit. If a unit isn't performing well, you're generally just tied to the lease term. You can potentially negotiate an early out or just not renew.
That flexibility sounds really good. Almost too good. What are the hidden catches, the pitfalls people might not see?
Well, the biggest trade-off is no equity or ownership. You're basically renting. So you don't benefit at all if the property value goes up.
Okay, you're just generating income, not building wealth in the asset itself.
Exactly. And there's higher risk if vacancy rises. You still owe that monthly rent to the landlord, even if you have 0 bookings that month. That can hurt.
Ouch.
Lease agreement limitations are huge too. You must have permission. Many standard leases forbid subletting or STRs. You need that specific clause or addendum.
So getting the landlord on board is key.
Absolutely crucial. And that leads to the final point, landlord dependence. Your whole business relies on that landlord. If they decide to sell the building or not renew your lease or hike the rent way up, your business could just poof, disappear.
Wow. Okay, so given those pros and cons, who is this model really perfect for?
Arbitrage really clicks for entrepreneurs who want to start quickly, maybe generate cash flow faster, and it's great for testing out markets before you commit to buying something there.
Got it. Testing the waters, so to speak.
Precisely.
Okay, moving beyond actually holding the property yourself, either as owner or tenant. Let's talk about the co-hosting or management model. This feels like a totally different angle, right? More of a service business?
That's exactly what it is. You're not the owner, you're not the tenant, you're offering a service to the property owner.
How does that work? What services are we talking about?
You manage their STR for them. That usually includes handling bookings, communicating with guests, coordinating cleaning, maybe minor maintenance.
Yeah.
Basically, running the day-to-day operations.
And you get paid.
How? Typically, it's either a flat monthly fee or, more commonly, a percentage of the rental income generated, say 20-30%.
Though the really interesting thing here, I think, is the capital requirement, or rather, the lack of it. This seems like the lowest barrier to entry financially, right? For someone wanting a hands-off approach with almost 0 capital.
Absolutely. That's the number one pro. No upfront investment. You don't buy, you don't lease, you don't furnish, nothing.
Wow.
Which also means low financial risk. If the unit has a slow month, well, your percentage might be lower, but you're not personally on the hook for a mortgage or rent payment.
Okay, that's a huge stress reliever compared to the others.
Definitely. And it's very scalable. You can manage multiple properties. There are great automation tools now, like Hospitable for messaging or Price Labs for dynamic pricing, that help you manage more units efficiently. Plus, doing a good job builds credibility. You get known as a good operator. And sometimes those owners you manage for might even become partners on future deals.
Ah, interesting potential there.
Yeah.
But, okay, if you don't have ownership, you must be giving something up, right? What's the downside to just managing?
You are. Like arbitrage, there's no equity or ownership. You're essentially trading your time and expertise for income, unless you somehow negotiate a small equity piece, which is pretty rare.
So less long-term wealth potential again.
Correct. And there's generally lower income potential per property. That 20-30% cut means your upside on any single property is capped compared to owning it outright.
Right.
You're also very owner dependent. If you have a difficult owner who won't approve necessary repairs, or maybe the property itself isn't great, that can reflect poorly on your management brand, even if it's not your fault.
Yeah, I can see that being frustrating.
And finally, you have limited control. The owner ultimately calls the shots on big things like major upgrades, maybe final pricing decisions, or guest policies. You advise, but might not have the final say.
Okay, so who should really be looking at this co-hosting or management route?
This is ideal for people who want to start with basically no capital, or for those who really want to build a portfolio of managed properties as their main business, offering STR services.
Makes sense. A service-based approach. Okay, now let's switch gears again and talk about partnership. The joint venture or JV model.
Right. JVs are all about teaming up.
So how does a typical STR JV work?
It's usually where you, the operator with STR knowledge and experience, partner with someone else who brings something different to the table. Maybe they already own a suitable property, or maybe they have the capital to buy one.
So one partner brings the deal or the money, the other brings the expertise.
Exactly. You bring the know-how to set up and run the STR successfully. They provide the asset or the funding, and then you agree on how to split the profits.
What's really powerful here seems to be that leverage. You're using someone else's resources, their money or their property.
That's the core benefit. Leverage other people's money, OPM, or other people's assets. You don't necessarily need to qualify for loans yourself or have a huge pile of cash.
That opens up a lot of doors.
It does. And the risk is shared. Expenses, potential losses, even the workload, it can all be divided according to your agreement. It's not all on your shoulders.
That sounds good.
There's also lots of flexible deal structures. It's not just 50-50. You can negotiate ownership percentages, different profit split tiers, maybe performance bonuses if you hit certain targets.
So you can tailor it to the situation.
Right. And it's great for IRA partnerships. You can bring in investors using their self-directed IRAs to fund deals, potentially offering them tax advantage returns.
Okay, IRA partnerships. We'll touch more on IRAs in a bit. But sticking with JVs, that shared risk and flexibility sound great. But sharing, does that also mean sharing headaches? What are the cons?
It definitely can. The big one is shared decision-making. You have a partner, maybe multiple partners. You won't always agree on everything, how much to spend on renovations, pricing strategy, you name it. That can cause friction.
Yeah, partnerships can be tricky.
They require good communication. There's also legal complexity. You absolutely need clear, well-drafted JV agreements. Often you'll set up LLCs or maybe use land trusts to structure the deal properly and protect everyone.
So lawyer fees are part of the setup cost.
Usually, yes. And obviously profit splits. You're sharing the pie, so you're not keeping 100% of the income like you would if you owned it solo.
Right, the trade-off for lower risk and capital needed.
Exactly. And finally, trust issues. A bad partner, someone who's unresponsive, doesn't hold up their end, or isn't trustworthy, can completely sink a deal no matter how good the property is. Due diligence on your partners is critical.
Definitely sounds like choosing your partner wisely is key.
Yeah.
So who is the JV model best suited for?
It's really ideal for STR operators who have the expertise, who know how to run these things profitably, but maybe lack the capital or borrowing power to do it alone. And it's also great for those passive IRA investors looking for hands-off returns by partnering with an experienced operator.
Okay, speaking of IRAs, let's unpack what seems like a really unique strategy. Using an IRA or even an inherited Roth IRA as the STR tenant. This sounds complex, but potentially powerful.
It is a bit more advanced, yeah.
So,
But the concept is essentially a form of arbitrage, but using your retirement account.
how does that work? The IRA leases the property.
Yes, your self-directed IRA. And remember, this has to be a self-directed IRA, not a standard one.
Okay, what's the difference quickly?
A self-directed IRA, or SDIRA, allows you to invest in alternative assets like real estate, private equity, notes, things beyond just stocks and bonds. You need a special custodian.
Got it. So the SDIRA.
The SDIRA, or potentially an inherited Roth IRA, which has some special advantages, enters into a lease agreement to rent a property. Then the IRA furnishes it and operates it as an STR business.
So the IRA is the tenant and runs the business, not you personally.
Correct. And all the rental income generated flows directly back into that IRA.
Okay, now that sounds interesting, especially from a tax perspective. That's got to be the big draw, right?
Absolutely. The number one pro is tax-free or tax-deferred income. If it's done within a Roth IRA, that income can grow and eventually be withdrawn completely tax-free, forever.
Wow. Tax-free STR income.
Potentially, yes. If it's a traditional IRA, the income is tax-deferred, meaning you don't pay taxes until you take distributions in retirement. Either way, it's a powerful wealth tool. You could potentially turn a relatively small Roth account into a significant cash-flowing asset without using personal funds or buying property directly.
That's pretty amazing.
There's also legal separation. Because the IRA is the tenant, it provides a layer of liability protection for you personally. And it's just a very creative use of retirement funds, especially for funds that might just be sitting idle, or particularly for inherited Roth IRAs.
Why inherited Roth specifically?
Inherited Roths often have favorable rules. Depending on who you inherit from, withdrawals might be tax-free, and you might have a long time frame before required minimum distributions kick in, making them great vehicles for long-term, tax-free growth like this.
Okay, tax-free income sounds incredible, but I'm sensing a but coming. Tax benefits usually come with very strict rules, don't they?
They absolutely do. This is not simple. You must avoid prohibited transactions. This is critical IRS stuff. It means no personal benefit. You can't stay at the property yourself. You can't pay yourself for managing it from the IRA if it's your IRA. There are strict rules against self-dealing.
Okay, so truly hands-off for you personally if it's your own IRA.
Generally, yes. You typically need a third-party property manager paid by the IRA. There's also UBIT risk. That's unrelated business income tax.
UBIT.
Yeah, the IRS can sometimes tax income generated from an active trade or business run inside a retirement account. STRs are often considered an active business. There are ways to structure things to potentially mitigate UBIT, but it's a significant risk you need expert advice on.
Sounds like you need professional help.
Definitely. This involves complex compliance. You'll need a knowledgeable SDRA custodian, probably a CPA, maybe an attorney who understands these specific rules. It's not DIY. And finally, limited financing options. Your IRA can't get a traditional mortgage or sign personal guarantees. Any financing would likely have to be non-recourse, which is harder to find and more expensive.
Okay, lots of hurdles there, despite the huge potential upside. So who is this really for?
It's best suited for investors who already have self-directed IRAs, particularly those with inherited Roths, who are sophisticated enough to understand the rules, willing to pay for the right professional guidance, and are primarily seeking that tax-free passive income potential.
Got it. Complex, but powerful for the right person. Okay, let's shift back to leasing models, but with a twist. The performance lease. What's different here?
A performance lease changes how rent is paid. Instead of a fixed amount each month, like, say, $2,000,
Right.
You and the landlord agree on a profit-sharing structure. For example, you might pay the landlord 25% of the gross monthly revenue your STR generates, and you keep the other 75%.
Interesting. So your rent payment varies based on how well the STR does.
Exactly.
The immediate thing that jumps out is how that aligns incentives. The landlord wants you to succeed because they make more money too.
That's the core idea. It creates incentive alignment. And a big pro for the operator is reduced fixed costs. If you have a really slow month, your rent payment is lower, or potentially even zero, which reduces your risk compared to owing a fixed amount regardless of bookings.
Yeah, that takes some pressure off.
It can also be an easier entry point sometimes. A landlord who might be hesitant about a flat lease for an STR might be willing to take a chance on a performance lease, sharing in the potential upside. Done right, it can be a win-win, especially for landlords who think they might get more than traditional long-term rent this way.
Okay, sounds like a clever structure. But if the rent is variable, are there complexities that come with that? What are the downsides?
Well, they can be hard to negotiate. Not all landlords like variable income. Many prefer the certainty of a fixed monthly check.
True.
It also absolutely requires accurate accounting. You have to be transparent and meticulous in tracking revenue and sharing those reports with the landlord. Trust is paramount.
Good bookkeeping is essential.
Non-negotiable. Your rent obligation is also less predictable, which can make your own budgeting a bit more challenging month to month. And naturally, there are possible conflicts. If profits dip significantly, maybe the landlord isn't happy with their share and disputes arise over expenses or your operational efforts.
Yeah, relationships can get strained when money fluctuates. So who's the ideal candidate for a performance lease?
It's generally best for STR operators looking for a low-risk entry or wanting to minimize fixed costs, and landlords who are comfortable with variable income and willing to share both the risk and the potential reward of the STR business.
Okay, one more model to unpack. This one sounds like a bridge towards ownership. The option to purchase model.
Yes, this is an interesting one. It combines leasing with a potential future purchase.
How does it work?
You sign a lease agreement for a property, just like a standard lease. But included in that agreement, or as a separate agreement, is an option. This gives you the right, but not the obligation, to buy that specific property at a predetermined price sometime in the future, usually within the lease term or shortly after.
So you're renting now, but you've locked in the chance to buy it later, at today's agreed-upon price.
Essentially, yes.
Now, that seems really appealing for someone who wants to get started, get the cash flow going, but maybe isn't quite ready for full ownership yet. They get control now, potentially buy later.
Exactly. That's the big pro. Control without ownership immediately. You can operate the STR, generate income, test out the property, and market.
Yeah.
You also lock in a purchase price. If property values shoot up during your lease term, you still get to buy at the lower pre-agreed price. That can be huge.
Yeah, protects you from market increases.
Right, and it gives you time to build capital. You can use the income from the STR, plus save additional funds to get your down payment ready for when you exercise the option. Plus, it can be attractive to motivated sellers, especially landlords who might be tired of being landlords but aren't ready to sell immediately, or who are open to creative solutions.
Okay, that mix of flexibility and future upside is compelling. But what are the risks here? It's not ownership yet, so what could go wrong?
A key risk is the non-refundable option fee. To get that option, you almost always have to pay the seller an option fee up front. It could be thousands of dollars. If you decide not to buy the property later, for whatever reason, you typically forfeit that fee. It's gone.
Ouch. So you need to be pretty serious about potentially buying.
You do. Also remember, there's no equity until you buy. During the lease period, you're still just a tenant. You're not building equity like a traditional homeowner unless maybe some of your rent payment is credited towards the purchase, which needs to be negotiated. There's also a risk the seller may back out. If the contract isn't drafted very carefully, a seller might try to wiggle out of the deal if, say, property values have skyrocketed and they regret locking in the lower price. Or they might even try to sell to someone else if your option isn't properly recorded.
So legal protection is vital.
Absolutely critical. These deals require strong legal protection. You need a rock-solid option agreement, properly executed and potentially recorded to protect your right to purchase.
Okay. So who does this option to purchase model make the most sense for?
It's best for STR entrepreneurs who desire that flexibility, want to start operating now, but also have a clear path towards future ownership without committing all the capital up front. Especially good if you think values will rise or if you need time to secure financing or save a down payment.
Wow. Okay. That was quite a journey through these different STR models. I mean, from buying outright to leasing creatively, managing for others, partnering up. It's clear there's definitely no single right way to do this.
Not at all. And if you connect all these dots, you see each model really does offer a unique mix of pros and cons. It comes down to your personal situation, how much capital you have, how much risk you're comfortable with, what your long-term financial goals actually are.
Yeah.
The real insight, I think, is understanding these trade-offs. How does each one build wealth versus generate immediate cash? How much control do you have versus how much risk are you taking on? It's about finding that specific fit for you.
Absolutely. And hopefully after this deep dive, you listening have a much clearer toolkit. You see the nuances of capital, control, risk, scalability for each approach now. We've really tried to unpack those details.
Which maybe brings up a final interesting question for you to think about. As this STR market keeps changing, keeps evolving, how could understanding all these different models help you not just pick one path, but maybe pivot or even combine strategies?
Combine them, like how?
Well, maybe you start with something low capital, like co-hosting or arbitrage, to build experience and cash flow. And then use that momentum and credibility to move into a JV or eventually use an option to purchase to secure your own property. Doesn't have to be just one model forever.
Using them as stepping stones. That's a really powerful thought, building strategically over time. Something definitely to mull over as you consider your own STR journey.
Exactly.
All right, well, that's all the time we have for today's deep dive. Until next time, keep exploring, keep learning, and definitely keep asking those interesting questions.